around us in order to compare it. Yes.
Okay. When is the deadline for that?
The deadline for that is next week. When I meet with Miss Lin again.
Okay, so you mean that the deadline for the submission is next week? Is that the due date for the group assignment next week? Now, Cường said it is in session 12. Where we are now, Cường? What session we are in now, Cường?
We are in session 9, so it means that we will have to submit the group submission at the end of April, around that time. Yeah. So we have 4 weeks left.
Okay. So today we are in session 9, right? So you have a 10, 11, 12. So effectively 3 weeks from today. So clearly you need to move on very quickly because you need to make sure that you submit the assignment on time for marking. And I believe that you need to do the video recording as well, right? Where you present, and then you need to record your video, and that will be marked as well. Am I right?
Yes, teacher.
Okay. Phương Anh, where is your group going now in terms of group assignment?
Yes, we are going to prepare for the group assignment, and we find out some information for this.
Mm-hmm.
Yeah, like competitor and some general information.
And I assume that Lin and Cô Kim provide, some support, some guidance for you to do the group assignment. Is that correct? Như Trâm, Đỗ Ngọc Như Trâm, is that correct? Is that Cô Kim and Lin provide some hint, some support for you to do the assignment?
Yes, of course.
Okay. So good to know. Okay, so you only have 3 weeks to go. So clearly you need to make sure that you move on quickly and make submission on the due date. So if you have any question, you can run it through me. You can email me if you have any particular question in relation to your group assignment. Okay. Okay. Any question you want to draw my attention before we go into the new lecture today? Nguyên Khoa, can you hear me, Khoa? Okay. Okay. So we move on with our new lecture today. Okay. So I'm going to share the slide to you. So just a second, please. Okay. So here it is. Assume that today we under topic number 5. Okay. Mỹ Hạnh, can you see the slide now, Hạnh?
Yes.
Okay. Okay, thank you. I just need to double check because I hear the keyboard on at my end. So, I mean, can you please make sure that you mute so it will not create, I mean, sound or noise for the class? Okay. Okay. Thank you. Okay, so we move on with today's lecture. Again, we continue with what we learned from last week. So 2 weeks ago, we learned valuation based on a dividend. And then the lecture before that, we focus on valuation based on the free cash flow. And the free cash flow, we can look at from the point of view of the free cash flow for equity holder or the free cash flow for debt holder and equity holder at the same time, or the free cash flow for the asset. So today, I mean, we're going to go to another method. So the method today focus on earnings. So focus on net income or comprehensive income. So today our focus will be on, we conduct evaluation, but our focus will be on earnings or on net income. So that will be the focus today. Okay, so you can see that actually one of the most important figures for any company, which is net income or earnings, no doubt in that. Even though in practice, I mean, we usually say the earnings is very easy to be manipulated. However, when things is manipulated, you can do it, let's say, in a year or so. I am not confident if the earnings can be manipulated for 5 years or for 10 years. However, when you look at the financial performance for any company, so one of the number we usually consider the bottom line number, which is the earnings, so that become very, very important. You see that in practice for the company, they will make, I mean, announcement in terms of their earnings forecast in every quarter, right? So clearly, I mean, they can make the earning forecast. Let's say they forecast the net income for next 3 months. What is that level, right? They can do it. And actually, the reason why they do it is because usually before they make announcement in terms of what is the earning forecast for next quarter, they are going to release the income statement for the last quarter as well. And if you look at the behavior of the financial market, you see that whenever the company... Sorry, Cường, which one you want to say, Cường? I misunderstand that you said teacher. What do you mean?
It's quite lacking while you are like delivering the lectures for last 2 to 3 minutes. Yeah.
So can you hear me now?
Yes.
Yeah, I don't know why. To be honest, I have no clue. I mean, I have your lecture on Wednesday, and I have another lecture on Sunday for Vietnam end. And I also run, I mean, the online class yesterday for ULI, because I mean that unit here, but that unit offer on campus, sorry, online. And then I usually for all the classes, I never get any problem, but I'm not sure. I can see the signal, I mean here, but I'm not sure what happened to that, because the same computer, the same internet, especially after, I mean, we need to stop early last time, I decided to use the work computer to deliver the lecture. but I'm not sure why the internet, keep lagging at your end whenever I do for this unit. Is that anything better now, Cường?
Yes, it's quite fluently. Yeah, right now.
Yeah, but the point is, when I ask you, I can see that, it takes about 10 seconds for you to respond. So clearly I can see, the lagging there. But when I ask you, I can see about 10 seconds later, that is when you respond. Đạt, can you hear me, Đạt?
Yes, I can hear you.
Okay, so Linh Chi, can you hear me, Chi?
Yes.
Yeah, not sure what the problem here. Phú Quốc.
Yeah, Quốc Phú. I can hear you now.
Quốc Phú, okay. Okay, so just go back to the story I'm telling here is, whenever the company make the earning announcement, so then what you will see is the response from the stock market very clearly. If the earning announcement is better than expected, so what you can see is you see the stock price will increase. So let's assume that as a fund manager, and your view is the earning for Vinamilk next quarter is 5,000 billion Vietnam dong. So you see that we present that number in terms of earning per share. This means that the net income divided by the total share outstanding in the market. So I will present this number in terms of EPS. So usually if all the professional practitioner in the market, they try to predict the number, they try to forecast about the earnings, because that is how they form their recommendation to their clients, right? So when the information become available, if the EPS become better compared to what they forecast, so what you can see is the stock price will increase. But if the earning announcement is less than what they forecast, so you can see that the stock price will decrease. So clearly on that basis, you can see that actually the whole market is looking for the earnings number, right? And the financial market will respond to the earning figures accordingly. So on that basis, the earning is a very good, or the earning carry a very good important information in order to do the valuation. And that explains why, in practice, one of the things or one of the methods people will use in order to do valuation is earnings, because that will become very, very important for them to see what is the valuation of the company by on their earnings. So let's go back a little bit to what we discussed in the past. So from the theory point of view, the value of anything is the present value for the expected future payoff. Right. And clearly, when you look for the numerator here, the expected future payoff here, you can use dividend. So that is when we say if you focus on dividend. So the question here is you consider how the wealth of the company is distributed. Right. If you use the numerator here as the expected future free cash flow, the one we discussed 2 weeks ago, so then you really think about distributable wealth. So it means that how the wealth can be distributable. If you focus on earnings, so you are at the other end of the coin, you don't focus on distribution, but you focus on wealth creation. So in practice, regardless of what method you are using here, the valuation will or should be the same. That's what I say in theory. In practice, the way we exercise, our caution, our assumption differently. So in practice, it is almost impossible for you to produce the same valuation using the different methods. And why is that? We go into that in a few slides later. So far we discussed about dividends, for valuation already. We discussed about free cash flow for valuation. And now, we complete, the last bit by focus on wealth creation in terms of we do valuation based on the earnings. So in the next, 10 slide or so, we will see why earnings is relevant for the purpose of valuation. What is the basis or the foundation for what we call the earnings-based valuation, to be on? In practice, how popular the method is, and if we need to conduct the sensitivity analysis, where are the key areas we should look at it? And then the final point is the potential causes for valuation error. So where we might get it wrong, when you use the earnings-based valuation. So, as the standard method, so there will be advantages and disadvantages when you use the earning-based valuation. The good thing for that is, the financial market, the stock market, and the company management will focus on the earnings. That becomes very important number. You might, remember that, earnings will be the fundamental basis for the allowance or for the performance compensation to the management. And in practice, right, some companies, even they try to implement the excellent project with the view that to increase the earnings in the short run in order to maximize the benefit they may receive from the company. So what it really means is, they know that overall that project is not excellent. They know that overall they should not implement on that project. However, if that project is in the position to improve the earnings in the short run in order to support their performance allowances, so then they will do it. So it becomes very important on that. The second point is the earning-based valuation, or we may call the residual income valuation. This is, they say, require fewer steps than the free cash. So what it just really means from there is, you can work out the income from your financial statement in order to produce the numbers. Whereas the dividend, you need to go into, further step before you calculate it. But for the residual income, you can do it. You can do the calculation directly from the income statement, right? So they are the two key advantages for earnings-based valuation. Concern, as I say, earnings can be easily manipulated, at least compared to dividends or cash. So that is why, people view earnings are not that, reliable when you use for valuation. So they will become double cautious when they use earnings for that purpose. And the second point is, the accounting world where we live in, that is the accrual accounting. So what it really means is you need to recognize, let's say, the revenue when it is sold, not when you receive cash. You need to recognize the expenses when it incurs, not actually when you pay for that. So on that basis, accrual accounting actually, they just simply reflect the accounting methods in terms of you need to do that, you need to do this, not actually in terms of the underlying economic value. So the two concerns are for the method for that. Okay, so now we see why the earnings is relevant to your valuation, or the value relevance of earnings. It means that how the earnings is or are relevant to your valuation. We say, earnings, regardless of you look in terms of net income or return on asset or return on equity, you will see that it is the most popular, the most widely used measure for firm performance in practice, right? And you can see that when you look at the financial statements, you have, 100,000 of figures in the financial statement. And the earnings is the only, number you can think of when they can report in terms of the per share basis. It means that what is the net income per share share, or we usually say the EPS or the earning per share. And if when you are trading in the market, another market indicator they use all the time when they are in the market is the PE ratio. So the P stands for the price and the E stands for the EPS, earning per share, and that is where the earnings number came from. And when you look at the net earnings or the net income, so then that is when you really look at the point of view of value creation or wealth creation on that. So now we jump into the residual income valuation, right? So what would just very similar with the dividend-based valuation in the way that this one still assume the clean surplus accounting. So what do we mean when we say clean surplus accounting? The net income, we need to include all income items. So you might remember when you look at financial statement, right? You have the income statement, and at the same time you have the comprehensive income. And the accounting standard, will not or may not allow some of the income to be, recorded in the income statement until you can realize the benefit or the cost for that income component. What is that about? We go into that. But the view here is the net for the clean surplus accounting, the net income will include all the income items. The second one, the dividend will include all the capital transaction between the company and the shareholders. So it's not only in terms of the periodic payment every 6 months or every year, but you also consider any inflow and outflow or the transaction between the firm and the shareholder. And again, for any company, we need to use the finite horizon residual income model. So it means that you can forecast for the next 5 years, and then you leave everything after 5 years to be considered in what we call continuing value, right? So now let's look at the quick example here to see how we can really consider, what we call the clean surplus accounting. It means that when you talk about income, it includes every income. When you talk about dividend, it must include all the, cash flow transaction between the companies and the shareholder. So let's assume that the shareholder equity on the balance sheet, so this is the book value, last year was 5,000. And assume that during the year, so during this year, the firm earned the comprehensive income for 600. They pay dividend to shareholder 360. They issue the new stock in order to get additional 250 cash, and they use 50 of them to repurchase common share. So if you look at the starting point is, 5,000. And during the year, so then the comprehensive income is, 600. Minus for all dividend, in this case, you see, including they pay 360 there. They issue the new stock for 250, and then they repurchase 50 for that. So B minus, I put the minus in front here. So you say that the book value at the end of year or the end of this year will be 5,440. In this case, what you need to be mindful is the all-inclusive dividend. It means that the dividend follow the clean surplus accounting in our example will be 160. It means that you not only consider about the amount of dividend they pay out, but you also consider all the capital transaction between the company and the shareholders. So, the dividend in our example is not 360, what you think, but that only or that should be 160. And if you play around with this equation, you can say the book value this year depend on the book value for equity last year, the comprehensive income for this year, and the dividend for this year. So you work it out from that. When you try to work out the dividend for this year, you get, the same reasoning of 160. That's what we call the all-inclusive dividend or the dividend following the clean surplus accounting. So now jump into the model. I mean, our focus there, and you'll see that it is very similar with what we learned in the past in terms of dividend based or in terms of free cash flow based valuation. The basic model here is, I mean, the different one when you look for the residual income valuation model is the value you do the valuation. It starts with the book value of the company at the time you do the valuation. Why is that? Because the thing is, the key component in that model is you only let's say consider what is the residual income. So you don't look at the total income. You just consider what is left over, what is remaining. So that explains why you need to start with the book value at the beginning when you do the valuation. Because there may be or there will be the case, the residual income for your company is a negative number. It is possible. If the comprehensive income for this year is less than, I mean, the required income the company wants in that particular year. So it is possible for this component to be negative. And that explains why for, I mean, unlike dividend based or free cash flow based, the starting point for this method is what is the book value for the company at the time when you do the valuation. So that is the starting point. And the remainder here is it can make, I mean, the value to be higher compared to where you start, or from time to time, it can be even lower, right? So, I mean, the book value, when you start the valuation, very easy because you know, I mean, what time you start and you know the information from the balance sheet, income statement and everything. So now our key focus will be on this one. Now, so now let's try to explain, I mean, what does it mean from here? If you look at the denominator, the discount rate is the equity or cost of equity capital. So the return on equity or the cost of equity will be used as the discount rate, right? If you look at, I mean, the top one here, you can see that, right? The return on equity, you time with the book value from last year. What does this one mean? This one simply tell you what is the required return given for that investment you want to earn this percent, let's say 5% for return on equity capital, and the book value the year before, let's say 1,000. So this component, the one in the bracket, simply tell you what is the required income you want from last year. And this one, I mean, the book they use the NI stand for the net income, but I prefer to look this way in the way it should be the CI, comprehensive income, not net income. I would prefer to correct this one to be CI, standing for comprehensive income, not the net income. So this one will tell you the residual income. So that's it, right? Okay, so given this one will last, I mean, forever. So that is why you can forecast, let's say, for 5 years. So this is the present value for the first 5 years. And then the second component here will tell you the continuing value. What it really means is, what is the value for all the residual income from year T+1, T+2 go to indefinitely, right? And a very important point here you need to be mindful is this is the residual income at the end of year T. So if you want to increase or you consider what is the residual income for year T+1, most of the time you are confused by simply taking the whole lot. You time for 1 plus G. So G represents how much the income will increase. But actually, the only thing that increase is the comprehensive income in this year, right? So that is why, I mean, don't multiply the whole lot by 1 plus G, just multiple for the comprehensive income in year T. It increased by G, so this component now will tell you what is the comprehensive income for year T plus 1. And then you take away what it means from there is the required return the required income for the year T. So that is equivalent to the numerator here, but for the year T plus 1. So the difference you can see there is the comprehensive income increased by G, and the book value for 1 year before, when you shift to the right 1 more year, so that will be the book value in year T. So if you are not going to time 1 plus G for this or for the second component. And this one, you might remember, I mean, this is the way when we use the dividend discount model or the golden crow model. So the two logs here, like what you see, I mean, this component and this component, it tells you what is the value at the end of year T for all residual income from year T plus 1, T plus 2 indefinitely. And this component simply you calculate back to the present value at the time you do the valuation. So, I mean, the formula is similar. The only thing is different from here is, I mean, need to be mindful. You only work out the comprehensive income for year T plus 1, and you work out the required earnings for the year T. So you need to use, I mean, BV, the book value at year T. So in order to work out the residual income, we need to understand some of it. So the residual income represent the asset earnings over required or normal earnings, or what you can call the abnormal earnings. So the normal earnings for the company is the return on equity times for the book value the year before. Where this one, the return for equity, this one, the book value at the beginning of the year. And the normal earnings will tell you the value creation on that. So actually, when you look at the residual income, that measure simply tell you what is the amount of wealth creation for common equity shareholders, right? So just the quick reminder from there, if you want to calculate the residual income or the abnormal earnings, so then you can use the comprehensive income for the same year minus for the required income for that year by using the current rate of return times the book value the year before. So that is the way we can work out the residual income. So, I mean, clearly, I mean, we will do some questions to support our theory on that. But if you look at, I mean, some of the steps in order to apply the formula, to apply the income, the earning-based valuation. So, I mean, first one, you need to forecast the expected future for net income. And then you forecast the book value for common shareholder equity at the beginning of the year. So that should be ET minus 1. And then you work out what is the expected future required income. And then, so this one will be the return, the rate of return time for the book value 1 year before. And you subtract this required income from your expected net income. So that will tell you the residual income, right? So for the discount rate, so we say, okay, so we use KPM. So don't forget, KPM is the expected return on equity, and you do valuation here. So the cost of equity estimated from KPM become relevant. We might need to do some adjusted for the capital structure change. This is, I will talk about this one more when we go into the valuation on the private setting environment. So whenever the capital structure is different, it means that you borrow more or you borrow less, you need to modify, I mean, KPM in order to make sure that your valuation is correct. So, I mean, the KPM tell you should be very familiar from here now. Expected return for your investment on risky asset depend on the risk-free rate, the beta or the systematic risk for that asset, and the market risk premium, which is the difference between the expected return on the equity market and the risk-free rate or the expected return on the risk-free rate. When you try to work out the continuing value, so then usually the analysts, they will forecast over the foreseeable finite horizon, and as we say, usually it will be for 5 years until the firm achieves steady state growth pattern. So I mean, the firm may never achieve this one, but usually the maximum we can do is we can forecast for 5 years, and then from year number 6 we let it go, and then you apply the growth rate to the net income, and then you applied the probability formula. So that is the Gordon growth model in order to work out the net income for all the years after your forecast horizon. And then everything you do the valuation, so you need to discount back to discount the value to the present value. So I mean, like any valuation method you can think of, the analysis will be very sensitive to the input. So that is why we need to consider, I mean, some sensitivity analysis. And actually, there is a very important concept. I believe I discussed it last time, but it is worth reminding here. When you talk about sensitivity analysis, it means that you try to understand what happened to the value when only one input changes. So let's say you consider what happened to your valuation when the cost of equity capital changes, or it is now different. What happened to your valuation when the growth rate in the income is now different? So what we call the sensitivity analysis. The other concept when we talk about is the scenario. So when you talk about the scenario analysis, so then the focus is you will let, I mean, at least 2 or 3 input to be different, and you see the combined effect on the firm value. So that's what we call the scenario. So we need to conduct, I mean, whenever you do the valuation, you need to conduct the different analysis using the different input to see how robust your valuation is, including a sensitivity analysis and a scenario analysis. Very obvious from there, the value of your valuation will go down when the discount rate go up, because if you consider it is riskier, so then everything becomes cheaper from your view. However, your valuation will go up when the growth rate, the key component when you try to estimate the continuing value, will go up. And due to, I mean, the constraint of the Gordon growth model. So then if you look at the Gordon growth, so what it tells you is P0 is D1 over the cost of equity minus G. So that formula is only sensible when the growth rate is higher than the discount rate. Actually, I will not put the equal sign here, because if the growth rate equal the discount rate, so then clearly it's not that sensible on that. So I prefer to see the inequality here rather than the equal sign between the growth rate and the discount rate. Right. So just now a little bit in terms of the implementation issue when you applied the residual income model on that. We'll just see what happened to that. The first one is again go back to the clean surplus accounting. So the first one is, I mean, there are some issue with what we call the dirty surplus. What we mean the dirty surplus, and in practice there are 4 dirty items. The question we ask is, should analysts include all the comprehensive income items? A quick reminder from here is, when you look at the income statement, you see that some income components are not there. The reason for that is they are allowed to be recorded in the other comprehensive income, but they are not realized in terms of cash or expense. So you are not allowed to realize them in the income statement. An example is, if you have the investment or the stock, they are available for sale, and assume that you are in the winning position. It means that if you sell it, so then you get, let's say, the profit of 1,000 compared to the book value, right? However, you haven't sold the security yet, so that potential benefit of 1,000 is not allowed to be recorded in your income statement. However, this one is included in your other comprehensive income. So the question now is, should analysts will include this item, right? Clearly, if you don't include, so then you might underestimate the value for the company. But if you include, so that will cause a very high degree of uncertainty, because at least at the time when you do the valuation, this investment security is not on sale, right? And then, the price will be up and down all the time, so that becomes the problem for that. Similar for foreign currency translation. What it really means is, especially, let's say, when you belong to the multinational corporation, you operate in Vietnam, so the functional currency is in Vietnam dong. But you need to report, right, your balance sheet, income statement, anything in US dollars, in order to be included in the consolidated financial statement for the headquarters based in the US. So just because the currency, up and down all the time, so then clearly there may be the gains or the loss. So your position there will face the gain or the loss. And the question here is, not sure if the analyst should include this one or not, because this potential gain or losses are not recorded in the income statement. However, this one is recorded in the other comprehensive income. One are still very, debatable in terms of your asset and the liabilities for the company, because for any company, they have responsibility for the pension or the post-employment benefits for their former employees. So clearly, this one not allowed to recognize in the balance sheet. However, it may affect to the whole lot of your financial statement. And the last one clearly depend on your hedging. So you just try to do something in order to minimize the risk, and then the potential gain or the potential loss is not allowed to be recorded in the income statement yet. However, it will be recorded in the other comprehensive income. So that's the first one. The second one, when we use for the residual income variation, is about the common stock transaction. And when you talk about common stock transaction, a very important point is, if you issue the new stock and that stock is traded, at the market value, so then there's no problem with that, right? No problem with that. However, usually in practice, when you issue what we call the employee stock option, it means that you provide the option for your employees to buy the certain quantity of stock in order to let's say your company. And usually in order to do it, most of the time the stock price will be offered below the intrinsic value or below the market value. And if that's the case, so what you can see is, it will affect your overall financial performance on that. The problem for that is, at the time you do the valuation, you are not sure if the employees will exercise their option in order to buy the stock. So that will make your valuation become very complicated, because if you believe that they do exercise and they get benefit for that, so it means that the benefit they get will need to be offset somewhere in the value of the company. However, it might not be the case, because they do have the option, but at the time when they can exercise the option, and let's assume that they don't see the value, so they don't do it. So clearly the common stock transaction, especially for the employees stock option, the problem for that. The number 20, when we so then the standard assumption is that comprehensive income should be available for the common equity shareholders, right? However, the income you use there, the comprehensive income you use there, I mean, may be used to pay dividend for the preferred shareholders. May be used to pay for the interest shareholders. It means that the one who not own, let's say, more than 50% in order to be recorded in the balance sheet. But let's say they just own, let's say, 10% of one of your subsidiary, so they can consider, so they are still considered as the minority interest shareholders. So your income needs to make that payment for them as well, and that is, I mean, something it makes the implementation of the method become a problem, because we're not sure if, I mean, the number there will be used before or after in terms of making the payment for the minority interest shareholder or making the payment for the preferred shareholder in that. Last one is the negative book value of common equity. So what you can see is, I mean, a lot of companies, they should have the negative book value for common equity. That especially happen to a very new startup, or the companies, I mean, that's new to the market. So when their liabilities is even higher than the total asset of the company. So, I mean, it's standard, not standard, but it's not that uncommon, right? So if that's the case, you should not use this method. The reason for that is, if you look at the way you calculate the residual income, so the comprehensive income in this year minus for the required income, I mean, for last year, just because the book value is a negative number. So you see that the negative and the negative will become a positive. So in this case, it is no longer the residual, right? It's no longer the residual. It now become, I mean, something it put on top of your net income or your comprehensive income. So that explains why when you are facing the negative book value for the common equity, you should not use this method for your valuation, and that become very obvious. So in principle, regardless of the method you use, I say regardless of synonym, regardless of you use dividend-based valuation or cash flow-based valuation or earnings-based valuation, you should be able to produce the same numbers. However, there is a very good statement when someone say, in theory, a practice and theory are the same. However, in practice, they are not, right? So what it simply mean that whenever you use 3 different methods for you to do valuation, it is almost 100% the numbers you get will be different. It doesn't mean that one method is wrong or what you do wrong when you apply 3 of them. It just simply means that the valuation is not the rocket science exercise, and regardless of you try your best in order to be consistent when you make the assumption. But given when you need to make a lot of assumptions and your assumptions are all over the place, so you will never be able to get the same valuation using different method. But from my view, it become actually better, and the reason for that is when you do the valuation, let's say using dividend, so then I don't need to care about anything for the free cash flow. And when I do valuation based on the free cash flow, I don't really care about the valuation based on the dividend or the income. So then when I complete the independent valuation, I have the set of figures in front of me, and then I can say, okay, I mean, valuation is not a rocket science exercise. Given I use the different method, and here are my final valuation figures, and then I can use my expert, or can use my expertise in order to make the final call, which figure appear to be the best value for the company under valuation. And that become, I mean, it becomes very standard practice in that, because regardless of how much you do, you never be able to produce the same number in terms of valuation. And some reason why we may or we will not produce the same number just because the incomplete or the inconsistent earnings and cash flow forecast. You know that when you forecast, a lot of things for you to do. So there's no guarantee. You can remember everything you put in the free cash flow or in the dividend, and then you use them in the earnings base. Even the way you calculate the weighted average cost of capital, WACC, the one you use, for the discount rate. So that may not be consistent in the way you estimate it as well, because given different method you use, apply the different one, and then it not the last one, but the last popular one is the way you calculate the continuing value. It is a problematic as well. Why is that? You know that continuing value contribute more than 50% or 60% of the total value. And even the way you applied the Gordon Crow model, different method, you will apply it in regardless of you try to apply in the same way, but the implicit assumption for that will be different. An example is, if you look for the income-based valuation, when I show you, you do not apply the G for the whole component of the numerator in year 5 or in year 3, but you need to break it down into 2 areas, right? The first one is you focus on the comprehensive income for year T, and then you increase that by G, and then the second one you don't increase by G, but you consider what is the required income when you use the book value at the end of year T, and you time with the cost of equity capital. So clearly, the way you treat the continuing value is different as well. Okay, so I believe that's all from the valuation with the focus on the income base. And clearly, the key point for that is, I go back to this one is the first one is, this is the way we work out the residual income. And the second one is, this is the way where we need to do the valuation. And the starting point is the book value at the time when you do the valuation. And here is the present value for all the residual income for the first 3 years. And here will be the present value for all the residual into indefinitely. Okay, so actually that will be the focus here, and I think that I will move on to do 2 questions. I think so. The first one is, try to apply with the information how we can work out the residual income, and then we go back to apply how to do the valuation using this earnings-based valuation. And then I will show you, using the Excel file for the case of, Apple or Walmart, in terms of how we do the valuation based on the earnings or based on the residual income. Okay, so now I will show the book to you. If you can give me, a second on that. I will show the book to you and let's do some questions together. Okay, here it is. The first question I really want to do is, just a second. So we are in chapter, we're in chapter 13. My computer is frozen. Cường, can you still hear me, Cường?
Yes, teacher.
Sorry. Okay. I think that I need to restart my computer. So I give you 5 minutes break, and then when we come back, I will restart and I will come back. Okay. So I see you in 5 minutes. Okay, you can take 5 minutes break. Rather than you sit in there and wait. Okay, so I think that now we should use some of the question in the book and reinforce our understanding about how we can calculate the residual income, and then how to do the valuation using this method. So the starting point is we're using some example from the book. Okay, so the question in front of you came from the book. So that should be question 14, right? I let you have 2 minutes for you to read the question, and then we will do together. Okay, so I let you have 2 minutes for you to read it, and then we do together. Okay, see how we go with this, okay? The question is, assume the following data represent the total asset, book value, market value for equity for 3 companies, Microsoft, Intel, and Dell. 3 firms involved in different aspects of the computer technology industry. They say Microsoft engaged primarily in the development, manufacture, and license and support for the software product. Intel developed and manufactured semiconductor chips and microprocessor for the computing and communication industry. Dell designed and manufactured a range of computer hardware, laptop, desktop, and servers. So they assume that they include the market beta for the companies and the analyst consensus forecast for the net income in year T plus 1. Right. For each firm, analysts expect all the comprehensive income item for year plus 1 to be 0. So we to try to keep it simple in terms of all the comprehensive income. So year plus 1 net income and comprehensive income will be identical, because the difference between that usually the other comprehensive income, but when they assume that it is now 0, so then the net income and the comprehensive income will be identical. Assume that the risk-free rate is 4% and the market risk premium is 5%. And you are provided with all the information here in terms of asset, book value, market value, common equity, and then here is the forecast for net income in year T plus 1. Right. First one should be very easy for you. Using the CAPM, compute the rate return on equity capital for each firm. Right. So from corporate finance, you remember? You remember how the expected return on equity is calculated using CAPM, Thanda?
Yes.
That's
Firstly,
how it is.
zero the risk-free rate plus the market beta multiplied by the risk premium.
Okay, thank you. Risk-free rate at beta time the market risk premium, right? You should say the market risk premium. So that is the risk premium for the whole market, right? Okay, so very easy from here for Microsoft. So risk-free rate is 4%. Beta is 0.96 and market risk premium is 5%. So you get what you get, right? So 4% plus 0.96 times 5%. So you get 8.8%. Similar for Intel. So 4% and the beta is 1.12. You times 5. So you get for Intel. And for Dell, so then risk-free rate is 4%. At beta is 1.28 times 5%. So that is what you get for the cost of equity capital. Right. Cost of equity capital. Now, what they ask you now is project required income for year T plus 1 for each firm. Okay, who remember the formula how we can calculate the required income? The required income from what we learned will be equal the return on equity capital, right? Times the book value. Cường sai CAPM times the book value. What do you mean by CAPM times the book value, Cường?
I mean the ROE, the number that we had just calculated in the I'm sorry, CAPMs in the methods, but I mean the result from the CAPM to multiply with the present book value, sir.
Okay, but what I want to emphasize here is because you are going to calculate the income for year T plus 1. So the book value you use will be the book value for year T, not for year T plus 1. Am I right? That is what I try to focus here. I say again, in order to calculate the required income for year T plus 1, the book value you use will be the book value for year T. And here it is for Microsoft. So you remember the standard equation for the required income is the required income for year T equal the cost of equity capital times the book value for year T minus 1. Am I right? So the book value is always 1 year before the required income. Why is that? Because you need to know your book income in order to say how much you want in terms of the return. Okay, so that's sensible. So that explains why the required income for year T plus 1 will be the book income for year T times with the cost of equity capital you just work out from question 9. Let's assume that for Microsoft, the using CAPM it is 10%, right? The cost of equity capital is 10%. So you yield 10% times this number. So that will tell you the book value, sorry, the required income for year T plus 1. Okay, so that is question B, and what I want to emphasize is required income for year T plus 1 will depend on the book value for equity for year T. Okay, now for C, they say project the residual income for year T plus 1 for each firm. Who can remember that? What is or how can we calculate the residual income for year T plus 1 for each firm? How can we do it? How can we do it? What we use? What should we use? View, remember how we can calculate the residual income? View?
Yeah, can you hear me?
Yes.
Yeah, so I mean, like, is it the net income minus the required income?
Yes, very good. Thank you for that. So that will be the difference between your net income, right? The net income here, minus for the required income you get from part B. Let's assume that for part A, assume that you get 10% for cost of equity capital. So the answer for B will be 10% times 39,000 here. So you get about 4,000 for example. And then the answer for C will be 16,250 minus for whatever the number, 4,000. So that's what you get the residual income, right? And what need to be mindful is based on the formula. So then clearly you need to use the comprehensive income, right? Not the net income. However, for this question, they clearly say they assume that the order comprehensive income to be 0. So that is why the net income and the comprehensive income will be identical. It means that if they let you know that the order comprehensive income, let's say, is 10, by that time, you need to make sure that you put 10 on top of this number, okay? Because this is only the net income and we're supposed to use the comprehensive income. And then for D, they say doing the ranking, rank the 3 company using the expected residual income for year T plus 1 relative to the book value for common equity. So very easy, right? So let's assume that for Microsoft, for question C, your answer is, let's say, 12,000. So now they say relative to book value. So you take 12,000. The answer you get from C divided for the book value here for common equity. So that is what you get for every firm. And then, I mean, depend on, I mean, the result, you'll see how we get for that. The last one, I'm not sure we can do it if we don't have the answer, I mean, on top. They say, what do the different amount of residual income imply about each firm? Do the projected residual income amount have explained the differences in market value of equity across these firms and explain? Okay, so clearly what they try to test us from here is in terms of, is there any link between the residual income and the market value for the company, right? Clearly, you need to do the calculation, but however, the key finding should be something like, if you look for the market value, Microsoft does have the highest market value, right? It's about 10 times compared to Dell and about 2 times compared to Intel. That when you have the remaining income, what is the signal you send to the market? The signal you send to the market is you are very profitable. The performance is very well. And when I started the lecture, what I did mention to you is why we can do valuation using the income, just because there is the strong link between the incomes and the stock market and the market stock price. Whenever the company make earnings announcement, you see that the financial market will respond instantly. If I am the fund manager, I run the fund, and I advise my client to buy Vinamilk stock, and my forecast is the income or the earnings for Vinamilk per share is 2,000. And then by the end of March, Mike Yuling make announcement. The earning income for Vinamilk is actually 5,000 per share, not 3,000 as I expected. You can see instantly the market will respond to that by, you see the price of Vinamilk will increase as long as or as soon as the earning announcement is made. So clearly, when you make a lot of, profit, when you have a lot of remaining income, it is very common sense. The market will receive that information as a very positive news. So I am very confident when you calculate the answer for C, the residual income, I am confident Microsoft will have the largest or the highest residual income. And clearly that high residual income will be taken into consideration in terms of the market value, because the market value is no doubt depend on the number of stock in the market and the market price. And assume that the number of stock outstanding in the market remain the same. So then you will see there will be, or there should be, a strong link between the residual income and the market value. No doubt in that. A lot of empirical studies, they try to see what is the effect of earning announcement on the stock price, and consistently they found good news or good surprise on income announcement will increase the stock price. Bad news on income announcement will reduce the stock price. It means that the financial market does respond to the earning announcement for the company. Okay, so if you do the calculation, I'm very confident Microsoft will have the highest residual income. Okay, the other one should be the same. So the one I want you to do now is, if you consider question number 17 for me, please. I give you a couple of minutes for you to read it, and then we do together number 17. Okay, so clearly, I mean, this one I would try to use Excel to do it. So, I mean, if you can take the picture of the question so that, I mean, when I show you Excel, so the book disappear. So if I can ask you the number, if you can tell me, because clearly we need to use Excel to do this question. Okay, so now that, I mean, consider one by one, right? So here we need to do the variation using the residual income and the dividend discount models, right? So the dividend discount model, you remember, it's just the way you can calculate the terminating value. The priority contractor provide maintenance and cleaning services to various corporate clients in New York City. The firm has provided the following forecast for the comprehensive income from year T+1 to T+5. So everything over there is for the future in terms of comprehensive income. Okay. So you have a year 1, year 2, year 3, year 4, year 5. So that comprehensive income. So they forecast for the next 5 years. The next one is the total common 2,224,401 on the 1st of January year T+1. So it's been that is the beginning value. Right? I say again, that represents the beginning value. Need to be careful on that. The firm does not expect to pay any dividend from year 1 to year 5. So it means that the dividend will be 0. The cost of equity capital is 12%. So that is the discount rate. So easy for that, right? What they want us to do now is compute the value of the company on the 1st of January year T+1. So beginning value. So this one is, I mean, at the end, right? This is the ending value, whether this one is the beginning value. Using the residual income variation model, and the firm expects the comprehensive income to grow 5% annually after year T+5. Okay, so I mean, look complicated, but it is not. Why is that? If you want to work out, the residual income, you need to know 2 things. Number 1, you need to know the comprehensive income. So here it is. I'm right. Number 2, you need to work out what is the required income. Right. So if you take the comprehensive income minus for the required earnings, so then what you get, it will be the residual income, and from there you can do the valuation. Okay, so now I will do this one on Excel for you. So I appreciate if you can take the picture of the number from here. So when I am in the Excel, when I ask you the number, you can tell me what is the number. Okay, so I will show you the Excel file, and we will start from the slide. Okay, my phone, can you see my Excel, my phone?
Not yet.
Not yet. Can you see now?
Oh, okay. Can see it now.
Okay, thank you. Okay, so the whole point of the valuation here, I mean, just some note here for you to see is valuation using residual income model, right? And very important from here is if you want to do the valuation using that method, you need to calculate the residual income. And the residual income, clearly you remember, it will be the difference between the comprehensive income, am I right? Minus for the required income, am I right? Yes or no? And the required income How can I calculate required income? So you remember for sure, in our example, the cost of equity, you time for the book value of equity. Yes, no? So I need to, if I want to do the valuation, I need to know this one. But if I want to know this one, I need to know this one. But this one now is actually given. Why I say given? You see that, I mean, they give you the comprehensive income from year 1 to year 5. So the only thing you need to calculate now is the residual income. Okay. So now let I start calculate. I mean, what is the residual income? Okay. So now let's go one by one, right? If I consider the year here, so let's say year 1, year 2, 3, 4, 5, and from 6, so it becomes constant. So I leave it there, right? So this is the year. Right. I need to see the start of the year. The start of the year. So the beginning value, that is something I need. And you see that, I mean, the way you calculate this. So at the moment, the start of the year value, what is the number? Can someone remind me? I remember 2 million something. 2224401. Am I right? 2224401. So that should be my my first number, right? Just remind me, I mean, if I put in the wrong number, okay? So that is the start of my number, right? How about the income? How about the income? The income for the year. For sure, you get it. It is provided. What is the number you get for the income? 478246. 478246. I just simply copy it. I mean, from it is given. Okay, so that is my income. And then you need to consider the dividend, right? But they say the dividend is they pay out nothing. So that is why dividend is equal 0. So that is why I have the ending value. The ending value. So you can see from there is I start with the year of this amount, right? And then the income I get for the year is that one, and I don't pay out any dividend. So then that is what I get. Okay. Now, when I go to year number 2, the ending value for year 1 will become the beginning value for year 2. Yes or no? Right? And I know the income for year 2. Let me go back. 491882. 491882. So that is the amount I get. And again, the dividend, they pay out nothing. So I do the same thing I get for that, right? So I do everything, but now I just need to put in, I mean, all the value here before I can copy across. Is the next number from here, 485568. And then the one after that I get is 515533. And then the final number I get is 554198. 554, I forgot. 554198. Okay, so this one is all given. So now I believe I can copy across. Okay, Okay, so I can copy across like that. So now I need to go to number 6 here. How can I calculate number 6 here? Is there any information where we can calculate what I calculate? Say again, good.
Teacher, about the assets of the start of year 5, I think there's some miscalculation from Excel. Yeah.
Okay, so what is the number, good?
The P trails, the number is 2 million, but exactly the number is like 3 million. P trails. I mean for the year 5, the start of year.
Oh, okay, okay. Why is that? Very weird, because it should be correct. Yeah, correct now?
Yes.
Yeah, okay. Yeah, because I just I forgot to copy them across. Okay. Okay. So this is the period where you can forecast. Now, my question is, how can I calculate what is the book value in year 6 when it become constant? Can someone tell me? Clearly, this one is equal to the ending value in year 5. Am I right? Yes or no? And this one is, if you read the question again, what they tell you is, assume that the comprehensive income in year 6 will increase 5% annually after year 5. So it means that you increase by 5%. So it means that this one is equal, this one I term with 1.05. Am I right? Because increase by 5%. That's what they tell you. So I get 5A1900. Okay, so that is what I get for year 6. And the dividend is still 0. So this one is I get okay. So that is starting from year 6 when it is yeah. Okay, so now you know the ending value. So clearly you can go back and see how can you fit into the calculation I put here already. Right. Okay, so let's see how we go. Right. The first one is, if you want to do the valuation based on the remain income or the residual income, so you need to know the comprehensive income. So you know that already. Now you just need to work out what is your required income. And required income will be your cost of equity. So which is, I put here 12%. Here 12%. Okay. Time with the book value for equity. Right. Book value equity. Okay. So let's go here. I go year. And then from 1 to 5. And then I will calculate the continuing value later. We'll do step by step. Okay. So that is my years. Second one is my comprehensive income. So the comprehensive income, I just simply copy from here for the next 5 years. That is my comprehensive income. Okay, all good. And then now I need to calculate, you see formula from here is I need to calculate the required income. Required income. So here I need to calculate the required income. And how can I calculate the required income? As you can see from here, I say the cost of equity 12% times the book value. Right. Book value here in this case in year 1, this is start of the year value. Year 2, start of the year or the ending value here. Right. So what I can do from that is my required income is 12%. Am I right? I time for what you get from here, start of the year. So that's what I get, 266,928. I don't want a decimal here, so I get rid of the decimal. Right? G. So if I want to copy across, the only thing I need to do now is, what is my E2? I need to fit this one. I put the dollar sign in front. So that requires income, and I will copy it down. So that should be correct. So that requires income. So I know the comprehensive income. I know the required income. So now I can calculate the residual income. So the RI stands for the residual income. Right. So the difference between the two, Cương?
Teacher, I think for the comprehensive income, it should be income, not the number you have paid, because that number is in the start of the year.
Oh, okay. Thank you, Cương. Sorry. So this one should be this one, right?
Yes.
Am I right?
Yes.
Yeah. Yeah, it's correct now. Okay, thank you. The comprehensive income is from here. Comprehensive income, right? Thank you, Cương. So the difference now is will be the comprehensive income minus for the residual income. That is what I get for the residual income. Am I right?
Yes.
So that's one for the first 5 years. So I mean, if I can work out the present value, so then very easy. It equal this one divided by 1 plus the discount rate is 12% for 1 year. For 1 year. And if I want to copy across, so I just need to use the absolute references for the discount rate. So I should be able to copy them down. And again, I don't want decimal. So what do we get from here in terms of the total? The total here will tell me total, right? This represents the value for the company in the first 5 years. Yes or no? Let me say again. The number 470, 779 represent the value of the company, but only for the first 5 years. I call this one, remember, the forecast period for 5 years. Now, forecast period value. Now the other thing I need to calculate here is I call the continuing value. It means from year 6 onwards. Okay, so this will be my calculation. Okay, so from year number 6, here, from year number 6, What is the comprehensive income for year number 6? I get it somewhere over there. Is that this one? 581,908. So that is my comprehensive income for that, right? And then how can I work out the residual income? Also, the required income. Required income is 12%. Am I right? If you consider for the book value, so you can time with this one. It doesn't look right to me.
That should be the beginning of the year 6 is the B13.
So sorry.
B13.
This one, right? Yeah.
Yes.
Thank you, Cơ. So that number look right. At least it's consistent with, the one before. So when you get something very weird, you know, okay, something wrong going on. And now, you know, the comprehensive income, you know, required income. So the difference between the two is that what you get for that 11 something. Am I right?
Teacher, I think that for the comprehensive income, we have to multiply with 1.05% because the growth rate is 5%. Based on the formula.
You mean this one?
Yes.
Oh, no. I haven't go to that yet. Okay.
Okay.
Okay. So this is actually this is the okay. Let me see. This is the comprehensive income when it increased by 5% already. Yes or no? And
yes,
this
yes,
is the residual income with the 12% with the book value. So that's one implicitly it include already. Right.
I see.
Yeah. So now if I work out, okay. So now something here you need to make sure that the first one I go step by step here for you to understand. The first so the number I am interested is it will be this number, right? That number is the number I am interested. But now in order to minimize the confusion, right? I calculate what I call P. Just trying to minimize your confusion here. B5. What does that mean? B5 will tell you the value at year 5 for all the income from year 6, year 7, year 8, year 9, year 10. Okay, so I put a note for here is P5 is equal the income in year 6 divided for the cost of return, the cost of equity is 12% and minus for the growth rate. Is that the growth rate is 5%? So 0.05. So this one will tell me the value at year 5. The value at year 5 for all residual income from year 6, 7, 8, 9, and 10. Okay, I can put a note here. And I can send this one to you if you want to. I put a comment here. I say it represents the value at year 5 for all residual income from year 6 onwards. Okay, so that is the meaning for that. So now if I really want to calculate the present value from here, so then it will need to equal this is the value in year 5. So you need to discount back for how many years? Clearly for 5 years. You discount back for 5 years. So this one now is actually the present value. Right? So this will be the present value. And if that's the case, so then I should be able to have my, what I can pull from here is the total value. So it will be equal the value for 5 years, and then the value from year 6, 7, 8, 9, 10, whatsoever. Okay, you know what I'm missing there? Can someone tell me what I'm missing? Why I get the number is too low, only 500, I mean 67,000, something like that. Why this number is too low? Can someone tell me?
You missed the initial book value from.
Yes, very good. Thank you for that, girl. So I will put it here is, I will say include the initial book value, or including the initial book value. Okay, so if that's the case, so this one I need to add. Now I don't want to confuse you later. Okay, this one is I call the total residual income. Okay, so that's the one. And then we consider the initial book value of equity, which is what is that? What is the initial value? That's one. Am I right? So the total value of the company is actually this number and that number. So should be this one now. Is that correct, girl?
Yes.
Okay, so I mean the total value is 2791,874. Okay, so based on the rounding, that's what we get. Okay.
I'm sorry. I'm like not sure about the amount that in the E24, like 96,000. What I don't know. How can you calculate it? Can you say it?
You mean this one?
No,
this one.
The yellow one, yeah.
Oh, this one. Okay.
Yeah.
So this is the present value. This is the present value for all the residual income from year 6, year 7, year 8, year 9, year 10. So if you want to understand this number, I strongly recommend you to go back to this number first, because this number will tell you it is the value at year 5, for all, and this is the residual income for year 6, day 23. I divided for the cost of equity capital is 12%, and the growth rate is that the growth rate is 5%, right? 5%. So then that is what I get from here. Okay. So this is the value at year 5. I need to go one round. Are you with me now?
Yeah.
But actually, one of the things we learn from the unit and you need to apply is what we call the mid-year adjustment. Remember what I showed you, from this book? This one will assume that everything occurs at the end of the year. Remember that? So the standard assumption in practice is, okay, because revenue and expense occur every single day of the year. So the more reasonable assumption is you assume that everything occurs in the middle of the year. So if that's the case, so just simply take the value when you assume it occurs at the end of the year, and you time with 1 plus for the discount rate should be 12% here, and divided by 2. So this is the way you calculate the mid-year adjustment. So instead of you say it should be 2,791,874, it should be this number, a little bit higher, if you assume that everything occurs in the middle of the year. Okay. Any question on that? So important point from this type of question is we need to make sure that we know how to work out the residual income. And if you want to work out this one, so then you need to know the comprehensive income or the net income and the required income. And the required income will be the product between the cost of equity and the beginning value of equity. So let's say if you work out the required income for year number 5, so then you need to use the ending value for year number 3 or the beginning value for year number 4. So it means that it's 1 year ahead. So the ending value for year 3 or the beginning value for year 4, it should be the same. And that is the way you calculate the residual income. Do you want me to send this one to you? You don't want it, so I just simply close it and I will not save it. Yes or no?
Yes.
I just say a lot up. I mean, in the window chat, I just want to say if you say yes. Okay, so I save it and then I will send it to you now. Okay. Okay, so I close that off now, and what? Wow. They say there is a comment that has not been posted. Oh, it disappeared. I don't know what's wrong with this one, but it disappears. I will need to write it here. I say the value at year 5 for all residual income from year 6 onwards. If you go to I will send that file to you now. Okay, Việt An, can you see my Excel file on the window chart?
Yes, teacher.
Okay, all good. Okay, so actually, I mean, that is the way, I mean, when you do for the evaluation, and I believe, I mean, question B should be similar. You just change the number and then everything should be the same. So, I mean, it's easy. It's not complicated when we put everything in Excel. Next week, I will go beyond, I mean, the lecture by providing to you some of the practical, I mean, example. So how we're doing. Okay, I let you have 10 minutes break. And when you come back, we look at our major Excel file. Okay, so let's take 10 minutes break. Okay, see you back in, should be 5:40 for your time, right? Yeah, should be 5:40. Okay, see you in 10 minutes. Bất động sản, nhưng mà tới cái tuần vừa rồi định chia sẻ với tụi em thì người đó lại bị F0. Người đó bị F0 nên người đó không có gặp được, thì không biết là tuần sau có khỏe hay chưa. Nhưng mà vì dĩ nhiên là vì nó cũng khác cái background, cho nên là cậu đó thì đang prefer là nói bằng tiếng Việt để chia sẻ nó nhiều hơn nha, tại vì thầy nói là trong lớp có người nước ngoài nên phải nói bằng tiếng Anh. Thì thực ra thì tụi em sẽ thấy là tụi nó sẽ thường là tụi nó sẽ không để ý tới book value hay market value gì cả. Ngày xưa nó mua cái đất bao nhiêu thì nó phản ánh bao nhiêu thôi. Nhưng mà cái vấn đề cơ bản là khi nó ra giá vốn hàng bán thường nó sẽ cộng thêm 20-25%. Thì cái con số đó thực ra lúc đó nó sẽ phụ thuộc vào cái uy tín của chủ đầu tư, phụ thuộc vào cái thời điểm của thị trường để mà họ xác định con số đó. Thì đúng là còn 3 tuần nữa mà giờ này mà giá đất đồ chưa có là sau này đua cái report là hơi bị đuối nghe, hơi bị đuối à. Năm trước là các bạn phải làm từ rất là sớm thì kết quả nó mới ok được chứ tới giờ này mà chưa xong gì hết là kết quả hơi bị đuối à. Tại bữa nào tụi em sẽ phải đưa ra là theo tụi em rằng là một square meter như vậy nó sẽ là bao nhiêu. Và em sẽ comparable với những cái dự án giả sử đã xây dựng rồi với được quyền cộng trừ nhân chia. Đặc biệt là trong thời gian vừa qua thì giá đất của Sài Gòn nó biến động cũng khá là nhiều.
Thì tụi em cũng tính là hỏi những cái bên môi giới bất động sản để hỏi giá đất hiện tại là đang bán là bao nhiêu thì để mà dự trù lên con số.
Ok. Okay, everyone, we come back. View, how about your group project going, View?
Good. We have a company. Good? Yeah, we have a company, so no problems.
Okay, that's very good to hear. Okay, let's go back to the Excel file you see for many time by now. Okay, Cường, can you see the Excel file now, Cường?
Yes.
Okay, so here is something we want to discuss about. So today, clearly, we focus on the residual income valuation. And I mean, just a quick look again, we have the data for Pepsi in the last 5 years or so, right? And then you use that data, you conduct the analysis in order to see, okay, how excellent it is, or if anything is inconsistent, let's say between revenue, cost of goods sold, net income, asset, liabilities, cash inflow, outflow, everything like that. So this is the financial statement analysis. And then everything you see from here, I mean, it belongs to the past. And then you try to forecast for the future. And the starting point for your forecast, usually they forecast with sale growth rate assumption. So okay, they assume that sale will increase by how many percent. And let's say for Pepsi, so they have a different market here, so they break down and they forecast in different market, and they come up with, I mean, about the number you see from there, right? So about 4.1% when they consider all markets together, something like that. So the sale growth rate. This is a very important one. And clearly different valuer, they will develop the different, set here, little assumption here, no right or no wrong. And then the next one is, I mean, when you really go to forecast, it means that when now you really go to forecast for the next, let's say the next 5 years in this illustration. So it means that, okay, so you use 3 years actual in the past together with your assumption, you forecast for the next 5 years. And then from year number 6, you will assume that, I mean, every year it will increase by the certain percentage, right? So this is when you put your forecast development into the forecast. Just before we go into that, I will show you the example. I mean, one of the evaluation. I mean, people who took this unit from Western Sydney University. But I run the valuation unit, and they do the valuation for the company, not for the real estate project, like what you do. And then I will show you an example, and I will tell you, I mean, something I will demonstrate to you, hopefully next week or the week after next week. Just a second. I will show you here. The problem is, okay, just give me a second, because I remember I put the name in. Okay, here it is. Okay, so I mean, it's just the assignment product, but the way Western Sydney doing is different with what your program is doing. So this unit, I just run it, I mean, recently, I mean, when I stuck in Vietnam last year, this unit offered by Western Sydney, but I was the one who ran it. So the requirement for this assignment is they need to do the valuation for the company, not for the real estate project like your requirement. And in this assignment, sorry, whenever I say the internet is not stable, so I will slow down a little bit. In this assignment, you see that they decided to do with Port of Hải Phòng, right? And the way they do is, okay, I mean, they do everything. They come with investment summary. Let's say in this example, so they illustrate on that date, the closing price for that and the target price for how long they go to that, the cost of capital, the growth rate, the present value for everything, even the enterprise value on that. So this one that is summarized. So this is really, let's say the way, I mean, if you take the CFA research challenge or something like that, that is something they're doing. All I want to show you from here is, I mean, if you look at this, I mean, student assignment analysis, so very standard one, they start with industry overview to try to understand their, I mean, competitors, something like that. Okay, so they understand about the company, why they do it. They need to do it in order to come with the view, I mean, how they make their forecast assumption for the future. So clearly, I mean, students who do this project, they will need to understand finally, I mean, the project very well or the company very well. That should be the same for you when you do the real estate valuation project. need to make sure that you understand the project very well. So all the background information is here. And then they do, they use the information in the last 5 years and they forecast for the next 5 years in order to do their valuation. It worth mentioning. So this is just a financial statement analysis when what happened in the past and what they forecast for the future in order to see how reasonable it is. They applied, even the two bond analysis or even the revenue and the CAP, so the capital growth rate, in order to see how stable it is. So they go to the valuation, right? But in terms of the technical one, the one you might miss here is, this is something what we learn in the future when you should not use the cost of capital as the discount rate, but you should use the APV, adjusted present value, when the capital structure, keep moving. Especially for the leverage buyout, when the company needs to borrow a lot of money to buy the company, and when they buy, so what they will need to do is they even may sell a very good asset in order to pay off the debt. So clearly the capital structure will be very different, and when it is different, so then we should not use the cost of capital as the discount rate because it is wrong. So in that case, we modify the method and we use the APV. So this is something I would try to show you, next week or the week after next week, when we actually can run the monthly cash flow simulation using the different numbers to see how risky, our valuation is. This is the example I will show you in Excel in today. When you try to run different scenario. So here they try to understand what happened to the scenario when they change the terminal growth rate and the discount rate at the same time. So this one done in Excel very easy, but this one, we need to do in the special software, and I can pass this software to you soon on that. So this is just the scenario, and we should have to do it. And then you see, they do okay. So because they focus on Hải Phòng port here, so what our project they put in order to create value. They go to all the project here. So all the appendix. Okay, I just go to the analysis. They even, consider the SWOT analysis in terms of the strength and the weaknesses and the opportunities and the threat for the project or for the company. Okay, they present the historical share price. So that was simple. All the assumption they put it here. They assume that every year in that, and the reason why they convince their assumption is okay. This is the pro forma income statement. So when they yield the information in the past 5 years and they try to forecast for the next 5 years, and you can see that they present the table nicely and professionally. So similar for the balance sheet, and the next one is all the asset and liabilities, the past 5 years and the forecast 5 years on that. Okay, so and then this is the cash flow statement based on what they forecast, because whenever you have different revenue, different, so then your cash flow will be different. And then they go to the discounted cash flow model. So if you can look from here, you see the way they go is they start with revenue, they consider the cost of goods sold, they go to gross profit, and then they go to EBIT, and then the income tax expense. So clearly you don't take out the interest expense, right? You take the income tax expense, you go to no part. So net operating profit after tax, you add back depreciation, and you minus the change in net working capital, you minus the CapEx, you go to the free cash flow. Okay, so this is the free cash flow for the next 5 years. And then they even run, the regression. So they say they use the market data, they use the stock. of all the companies in their portfolio. They use, I mean, the OS regression. They run quantum regression on that in order to demonstrate. So from the data here, because clearly, I mean, Hải Phòng Port is not listed. So then to go to the asset data. And from the asset data, then they use the actual gearing for Hải Phòng Port to redeliver beta again. And the whole purpose for that is they do it in order to calculate the cost of equity using the capital asset pricing model, right? And then here is, I mean, when they use the market comparable, this is something we learned next week. So they try to use the EBITDA over the enterprise value forecast. So the enterprise value, I mean, they get it from on the top here, somewhere on top, the enterprise value. So they go to the EBITDA, the multiple of streams, so go to the enterprise value, they take away the debt equity, so the share outstanding, they go to the estimation for the equity value per share. Here is, I mean, the peer comparison. I mean, they try to convince me as the marker why the Hải Phòng Port should be considered comparable with all the companies from there. So they can see in terms of, I mean, net income margin, in terms of gross profit margin, return on equity, book debt over equity here, and then EBITDA multiple, right? So they do fair bit of thing here, and then they even go to the ESG, the environment, social, corporate one. To say environment, what happened to that? Social, what happened to that? And so they try to, I mean, put their view in terms of how risky, I mean, the company operation is in order to, I mean, affect their valuation by all the input. So operation knows risk, and they put everything there. So what you can see is actually it is a really right effort. I mean, when you really want to do the high quality valuation one, the very important one. The requirement, I mean, for this assignment and your assignment is not the same, because for this one, my requirement is, I mean, they do it for the company, right? They do it for the companies or for the project. I mean, but it's not the real estate project. What you can see from your assignment is for the real estate, mainly people look at the market comparable. Because for the real estate, when you try to do the free cash flow, you see that it's really complicated and it really makes no sense. The free cash flow is actually fundamental to everything, but you will see that the final number you land for your project, you need to be mindful about the market relevant. It means that what is the market comparable, and make sure that you pick a very, very good group of comparables when you compare with your project. Don't forget, I mean, the real estate market in Vietnam, especially in Ho Chi Minh City, was so different for the last 3 years or so, right? If you look at the house price, everything, you see that it's really horrible to think in that way. So clearly you need to factor the information like that into consideration, because your valuation is now in 2022 after Vietnam really enjoyed a significant positive growth in the housing industry, especially most of project you collect came from Ho Chi Minh City or the nearby cities, right? So I mean, try to use the free cash flow valuation if you can. I mean, work out some free cash flow if you can, and for sure, based on the free cash flow, you should be able to land on some number on that, and double check with, I mean, some successful trading in the market in terms of, let's say, per square meter price in the same area came from the similar investor or the timing when the project is launched. But don't forget, I mean, a key point for valuation for real estate, the focus should be on comparable.
So if you want to sell the house in near Ho Kwang Road from that house, but it's more about what is the asset which should be comparable and that recently sold in the market. And then let's say if they sold out similar house in the same area for 100 billion, so you will add up or you will discount from that 100 billion Vietnam dong in order to go to the price. So clearly, I mean, I strongly recommend you to apply the free cash flow for your project, but the nature or the characteristics for the real estate project will be, I mean, on the comparable. Just some of the real estate, I mean, valuer. Usually, the cost of the land in the project will be about 20 to 25% maximum, and then everything all together, it will never go to more than 70% or 75%. So you can see that for the real estate project, the markup usually about 20 to 25% in Vietnam. And I believe when Hoàng Anh come to see you next week, he will share with you, I mean, something, I mean, a view, because not because, but view in the unit. So I did request Hoàng Anh to deliver in English so that view can benefit from his expertise. But clearly, I mean, if you have any question, I mean, out of the guest, so then clearly he will tell you a lot about, I mean, good insight for that. He stayed in the industry for about 10-12 years by now, and he is the key valuer for Duckson. And I think he's the one who really, I mean, behind the valuation for Duckson in the last 10 years or so. So he stayed in the industry, I mean, very, very long. He knows a lot about that. He was my student from Vietnam Netherlands program long time ago. I mean, I just try to take him to your class, I mean, to share some of the insight, and supposed to do it last week, but he got COVID just, I mean, one day before he's supposed to talk to you. So that's why he request for the delay, and hopefully next week he will come to see you on that. Okay, so I mean, I do know a lot about real estate valuation. I mean, given my background, my career, I'm not professional in real estate in Australia. Usually we do for the company, for the project. We don't do for the real estate. I mean, but when I'm in Vietnam, so involved on that. So I mean, any problem for the practical one, you can talk to me. But Hoàng Anh will be there to talk with you about that next week. Okay, so what I just show you is, I mean, it's just the assignment from the similar unit, but taken from different approach. When they handle that. Okay, now I go back to the Excel file here. Okay, so we go to the valuation now. Cường, can you see my slide again? Cường, can you see that now?
It's loading. Yes, I can see now.
Okay, thank you. Okay, so here you say, I mean, residual income variation is, I mean, very easy. And you pick year number 6 in order to work out the continuing value. I will go to show how we work out this one, but I mean, the key thing from that is you need to work out what is the comprehensive income available for common shareholders, right? And then you need to work out what is the beginning or the lack of beginning book value for common shareholder equity. So at time t minus 1. So if this one is 2020, so then it should be 2019 for this. So that's just 1 year before that. So I mean, the required earnings will be the product between the cost of equity and the book value of the year before. So that is the required earning, and the difference between the comprehensive income and the required earnings will tell you the residual. All right. So you know the residual income for the first 5 years, and this one will be something here. So if I can note it here, just in case, I mean the note in the file I sent to you disappear. This one just simply mean this number 5527. The meaning for that is it is the value at year 5 for all residual income from year 6 onward. So that is the meaning of that, right? It's the value of year 5 for all residual income from year 6 onward. So that is the meaning for that. So even though it here, you need to work it out, right? So the present value is there. So the present value just simply 1 over the cost of equity, and let's say this one is for 1 year. So you see E151. You can work out the present value for the residual income for the next 5 years, because now they all present value, so you can add them up, so they will become the total. For the present value, so you can see actually this one is not correct, put it there. So you can see this one is the present value is, I mean, you get this one is the residual income for year 6. You need to work it out what is the value in year 5 for everything you receive in year 6, I mean forward. And then from year 5, you discount back 5 years in order to go to the present value. So if we look at the first equation from here, that equation will tell you what is the value at year 5 for all residual income from year 6 onwards, and you use Gordon growth model or dividend discount model. And the last one you time with I161, that is this factor. So that is the present value factor after 5 years. So when you time with this one, it takes the whole value to go back to year 0. It means the present value. So now you know the first one is the present value for the residual income for the first 5 years, year 1 to year 5. And this is the present value for all residual income from year 6, 7, 8, 9 forever. So you go to total. You need to make sure that you add the beginning book value for equity to 127 here, the present value of equity. But then you need to adjust for the mid-year accounting. So with the view that, I mean, revenue and expense can be all over the place. And then the standard assumption is we assume that it will curve in the middle of the year. So you go, and this why the way you do it is you just take 1 plus your cost of equity divided by 2. So from that, you get on to the present value of equity, taking into account mid-year discounted. And you have this amount of share outstanding in the market. So then you get the estimated share value for that. And then you can compare to see how it differs. So now just go back to some of the numbers from here. The first is I want to look at what we mean by the book value for commerce one. So don't forget you are at year 1. So it means that the number you see from here, it will be the value at year 2. And if you go to D, let's say 237 from here, D237. So it's further down from here. 237. You say this is the book value, right? This is something in the past for the book value for equity, and this is something you forecast for the future, right? So now you try to work out the residual income for year 1, 2, 3, 4, 5. However, the book value for equity, you need to yield for year 0, 1, 2, 3, and 4. So you need to yield 4 number from there. Okay, so this just simply tell you the total common shareholder equity. And you see, you start with preferred stock, and then all the common stock, and add in or additional paid in capital, all retained earnings. You can see all the accumulated all the comprehensive income. You look all the treasury stock or all the equity adjustment, and then you go to the. So you are not going to yield from year 1 to year 5, but you should yield from year 0 to year 4. And that's the reason why you see from here, we get from year 0 to year 4. So this should be the book value for common equity at the end of year 5. It's been at the beginning of year 6. So it is very often for this one. So now we look for the comprehensive income. So you can see that the different, the comprehensive income and the net income should be different, because you may have something in the non-comprehensive income. That. So if you look at the forecast here, so you will see that if you go to the income segment, so I hope it's somewhere up here. So I just go to the income segment, right? No, this a bit, yes, okay. This is the income segment, right? So you will see we have, let's say, okay, you start with all, I will go to that, but if I want to show you here, we have income before tax, and then you have a net income, and net income attributable to non-controlling interest. Here, you see that clearly in this example for the case of for the case of Pepsi. You see that they do have some other comprehensive income items. Okay, they do have some item like that. Even though when they try to forecast for the future, they say, okay, it is not that significant, and for some reason it becomes very uncertain now. So they assume that everything now it becomes 0. So if the other comprehensive income item is 0, it means that your comprehensive income now and your net income should be the same. The income after tax, the net income here. Here. So you will see, if you look at this line compared to this one, right, you will see that how different it is. It's not that, it's not that significantly different, am I right? If you see the difference between the two, let's say the net income here minus for this one, so you will see that tells you the size of the difference. So about 11. The size of the difference is, about the same. So it just sends a strong signal here. It's just because of you are different in the way you exercise your assumption. And you look for 11. Let's assume that 11, this number should be billion. So you say, okay, 11 billion is a lot of money too. I agree with that. But if you compare 11, let's say, with this number, so you see that actually it's about 0.1%. So anything, less than 0.1%, it's too small. So, we can ignore on that. Okay, so clearly the key point here is, you need to make sure that the comprehensive income and the net income, they are only the same when the other comprehensive income item is all 0, right? So that is the condition for that. So if you look for the comprehensive income available here, you look at the forecast E100 minus E258. So to go back to see what is E100 and what is E258. So E100, so here it is, that is your comprehensive income, and E258. So no doubt it should be the other comprehensive income, no doubt in that. Oh, no, sorry. They take out the preferred dividend, right? So the comprehensive income, because they assume that they forecast the order comprehensive income is 0. So it means that the net income and the comprehensive income are the same. So in order to work out the comprehensive income, they use the net income, they take out the preferred dividend, because I mean you need to pay the preferred dividend before you can think of it will be available for common or for equity shareholder here. So you say, I mean, that is now your comprehensive income, that is now your book value. So you can work out the retained earnings, and from there you can work out the cash flow for your method, and from there you can work out the value for your company, right? The next one is I want to show you how. Okay, so at the moment it is very obvious. It is very obvious. The share price is 85.86. And this number came from your assumption in terms of the growth rate is 3% and the discount rate is 7.5%. I say again. This valuation here, 85.86, came from your assumption that the long run growth rate is 3% and the discount rate is 7%. I will show you on the top here. I will show you for sure that will be the case. Here you are. This is the discount rate you use. Okay, 7.5% for your variation. And this is the growth rate you use. Where's my growth rate here? Okay, so what it really means from here is, I mean, for all the variation in this, illustration, the cost of equity is 7.5%, and the cost of, and the growth rate is 3%. So that is why when you do everything and when you go to our residual income valuation, you go to this number. All right. Now the question we ask ourselves is, what happens if the long run growth rate is not, let's say, not 3%, but it can be 0%, 2%, or 4%, or 5%, or whatsoever here. So it you can pick the number you want to think of. Or what happens if the discount rate is, 7.5%, not 7.5%, but let's say 6% or 10%, right? I mean, the option you can do is, and that's very manual. You go to the input, from here, and then you change the number. You change this one to, let's say, 4%. So then for sure, everything will update it for you. No doubt in that. So you can do it. But there is the better way for you to run that. That is what we call the scenario analysis. So I will replicate this table for you. Is when you say, okay, you need to work out when the long run growth assumption now different, discount rate different. What happened to your in the intersection between the row and the column, right? You need to link with the value with the formula from your valuation. So this is your valuation, right? Okay, so 85.86, and my assumption in order to get this number is when the growth rate is 3% and the discount rate is 7%. So now my question is, when I change the value for the growth rate and the discount rate, what is the value of my stock? So what I do is I just simply highlight this area. I fill that table. I go to data. I go to what if analysis. I go to data table. The two input they ask me is, the growth input cell. So the growth, this is the growth. So the growth is the long run growth assumption. And the column input cell is the discount rate or the cost of equity, right? So for the growth input cell, then I go to the growth input cell from here. When I assume that 3%, where I show you, that's one. And then the column input cell when it is 7.5%. And for sure, I hope that, I mean, we do the calculation, we use that. I press OK. I go to the table. You will see that this table now calculated for me. Right. So when you see the div here, because if I mean sensible, the discount rate equal with the long run growth assumption. So the denominator becomes 0. So it makes no sense. So that's why all the number here make no sense. So that's why you cannot get that. But the number you see from there is, I mean, 7.5% and 3% is actually what I show you from there. 85.86. You look at this one, okay, you say that when the discount rate is 15% and the growth rate 3%, the value for your stock is 33%, something like that. So clearly, I mean, by using data, go to by using data and you go to the you go to what if analysis, you should be able to do it. Right. So that is what we call the sensitivity analysis. Sorry, I'm kidding out. Whoever, I mean, the host, can you please return the host to me? Please?
Yes, yes.
Okay, I'll just go ra. Okay. Okay, so I will share you, I mean, the file again. Can you see the Excel file now, Linh Chi?
Yes, I can see it.
Yeah. And then, I mean, it's very, I mean, simple. I mean, you can run the different scenario from here. Or even, let's say, you can do the better way. Let's say you say, okay, I mean, you don't want a table like that. You want something better, let's say from 1% to what is that? Let's say 1%. And then you just want to increase by 0.5. No, it becomes too much. So equal 1.5%. Okay. By 5%. So let's assume that you want to run the different scenario like that. Okay, everything is increased by that. And you don't want to prepare the table like that. So what you do is actually you just need to let's say you put it here for an example. You want to include everything from here. So what you can do is you can go to I remember where it is. I think data. Where is that? I look for the data here. Data validation. I say, okay, I go for the list and I want to include all the number from here in that list. So what you can see from that is now I do have the list from here, right? So when I go, then I can pick any number from here and it will be updated for me automatically. So this is the table, I mean, a powerful table, but you can do it better in the way that you can, I mean, create the drop. Okay, So that's all for my illustration today. I strongly recommend you to start moving on quickly with your group assignment, because I don't see you have a lot of time now. If you need, support, if you, need to talk, so your group can request a meeting with me, and I will be more than happy to respond to your questions. So just do it if you want to. Till next week, I will try to send you the crystal ball. So crystal ball is, I'm not sure because view in the class, but that is not the sorry, view, yeah, in Vietnam view. It is the how can I say, the version on my computer is legal, but I understand that the version, someone used out there is not legal. If you want to learn something, and again, I need to say sorry to View about that, because View should be very difficult to understand that. But not many software in Vietnam is legal View. That is something to be mindful about. For some reason, they get the illegal version, everywhere. But the version I have in my computer for sure, that is a legal version. The crystal ball software allow you to conduct, very excellent things about the how risky your variation is. So it will tell you exactly, what you mean on that. Okay, so I will conclude my lecture tonight here, and I strongly recommend you to move on with your group assignment. And then any problem, you can email on Teams or on Google or whatsoever, whatever fit you. Just prepare the long list of questions you want to talk to me, and then see how it goes. Okay, any question before I let you go? Okay, so if not, so thank you for your time. I see you in 2 weeks. Yes, you can email me and CC all your members in your email, and we will discuss the time we can meet. But for sure, I will arrange my time to meet your team. No doubt, I will for sure. Okay. And in order to maximize the benefit for our meetings, I strongly recommend your group to have the meeting with you guys first, and you list all the questions you want to double check with me. Okay. Okay, so clearly, it is not worth, if you just have a one question, because we do it over email quicker. But let's say you discuss with your group, you do it a lot, and you have a ton of questions, 20 questions altogether, or all the questions. You can request for the meeting, and I can tell you 10, 20 minutes, we can answer a lot of questions for you. Okay. Okay, guys, thank you for your time. I will see you in 2 weeks. Okay, thank you. Good night.
Thank you.
Recording stopped.